ICRA has recently revised upwards the outlook of passenger vehicle segment and the auto component segment from negatives to stable. The other factor which has a significant bearing on the automotive industry over the medium to longer term is the recently announced PLI scheme. The scheme aims to make India a part of global value chain in manufacturing and plans to attract fresh investments. It has allocated 57,000 crore for the auto segment and another 18,000 crore for the advanced chemistry batteries. These incentives have the potential to kickstart significant investments in the coming years and help the industry achieve globally competitive scales. In our presentation today, we would be covering ICRA's expectations of growth across segments, key challenges like hardening of commodity prices, and our expectations on margins, Capex, and leverage. Let me now introduce our guest panelists today. We have with us Mr. Deepak Jain, the Chairman and Managing Director of Lumax Industries Limited, the flagship company of the Lumax Jain Group. The group is a leading player in automotive lighting and gas shifting systems. The group has multiple manufacturing facilities across locations in India and even outside India. Besides managing his business, Mr. Deepak Jain holds multiple responsibilities in the industry. He is currently the President of Automotive Component Manufacturer Association of India, Vice President of Toyota Kirloskar Supply Chain Association, an Executive Committee member of Maruti Suzuki Supplier Welfare Association, and Tata Motors Supplier Council. Welcome, Mr. Deepak Jain. Thank you for taking your time off from your busy schedule. We look forward to an engaging discussion with you on the industry. We are also pleased to host Mr. Vinay Mehta, Director General of ACMA. He has been actively involved in the promotion, growth, and development of the auto component industry in India for about a decade now. We have hosted him in the past as well. Welcome, Mr. Vinay Mehta. Thank you for joining us, and we look forward to your insights on the industry today. From ICRA side, we have with us today my colleagues and our automotive sector experts, Ms. Pavitra Ponaya, Ashish Modani, and Vinuta. They have been covering the sector for over a decade now and are the author of our sector research reports. They are also responsible for ICRA's rated portfolio of around 140 auto component entities, besides large number of automotive dealerships and the major auto OEM across all categories. We will start the session with a presentation on industry outlook, which will be followed by a moderated Q&A session with Mr. Deepak Jain and Mr. Vinay Mehta. I now request Ms. Vinuta to make the presentation.
Good evening, everyone. To set the ball rolling, let's start with the poll. Anju, can we have the poll, please? When do you see Capex reviving to pre-COVID levels? The options are H1 FY22, H2 FY22, and FY23. Requesting all of you to record your response. We will give you the results at the end of the presentation. Moving on to the presentation, we will first cover ICRA's economic outlook and demand dynamics. We will then move on to how this translates into performance and outlook for the auto component industry. The later sections will talk about Capex forecasts and rating movements. A bright outlook for the Rabi season and greater visibility of an approaching vaccine rollout will strengthen demand and economic activity in Q4 of FY21. And ICRA now expects the FY21 GDP to contract by about 7.8% in real terms, as against 11% expected earlier. ICRA expects India's real GDP to grow by about 10.1% in FY22, led by continued normalization in economic activities and the low base. This is expected to boost consumer confidence and augurs well for the auto component industry. About 51% of the auto component demand was from domestic OEM segment in FY 2020. Another 20% came in from domestic replacement, while 29% was from exports. ICRA Research currently expects the automobile volumes to decline by a lower 13 to 15% in FY21, as against estimates of 17 to 19% earlier. H2 of FY 2021 is expected to be significantly better than H1, capping the overall sales volume decline for FY 2021. Improvement in consumer sentiments and expected pickup in economic activity would be key growth drivers for passenger vehicle sales. Despite the sequential recovery in commercial vehicle volumes visible in the recent months, ICRA expects CV volumes to contract by 20 to 23% in FY21, bringing it down to the lowest levels in more than a decade. Although growth would be optically better in FY22 at 24 to 27%, the recovery to industry volumes to the previous peak will remain some time away. The aftermarket segment witnessed sequential recovery in Q2 and Q3 FY21, and with the opening up of the economy, pent-up demand for replacement of vehicles and festive season demand. Q4 is expected to be buoyant for this segment, resulting in flattish to low single-digit decline for full year FY21. We now move into exports. In CY 2020, the global light vehicle sales declined by about 15 to 17% because of extensive spread of the pandemic across the globe and its bearing on consumer sentiments and income levels. While a growth of 7 to 8% on year-on-year basis is expected in calendar year 2021, the recovery is expected to be prolonged and gradual, taking anywhere between 4 and 5 years to reach pre-COVID levels. However, rebound in the commercial vehicle segment seems to be stronger, with North American Class 8 orders having rebounded to about 52,000 plus vehicles in November and December 20 for the first time since August 18. Renewed confidence and momentum in manufacturing activity have resulted in robust freight growth, translating into orders. Moving on to commodity prices, steel, aluminum, and copper have witnessed significant price increases in the last 3 months, and this is likely to continue in Q4 of FY21 as well. Steel is at an all-time high, while rubber is at a 6-year high. As a result of surge in commodity prices in Q3 of FY21, the weighted average commodity index has surpassed FY 2020 levels in 9 months of FY21. Electronic components have also witnessed supply disruption and shortage, leading to due to increased demand in consumer electronics. This has resulted in surge in electronic component prices as well. Further, INR depreciation in 9 months of FY21 has remained a worry for net importers. Demand in Q3 of FY21 has been robust, and the momentum is expected to continue in Q4 FY21 as well, resulting in healthy YOY revenue growth for H2 of FY21 for auto ancillaries after a 30% year-on-year decline in the first half. Tire companies are also expected to witness healthy growth in H2 of FY21, supported by OE, replacement, and the export segments. However, hardening of commodity prices and rollback of pay cuts and other temporary measures are expected to result in sequential weakening of margins in Q3 of FY21, despite strong demand. After a disastrous Q1 of FY21, the domestic automotive demand has reported sequential recovery in volumes in Q2 and Q3. The performance was much better than our estimates, especially in the passenger vehicle and tractor segments, resulting in our growth forecast revision for FY21. ICRA now expects an overall revenue decline of around 12 to 15% as compared to 16 to 20% decline forecasted earlier for FY21. Further, the growth in FY22 is likely to be strong at 16 to 18% because of the expected pickup in automotive demand, low base of FY21, and impact of commodity on realization. Disruption in automotive production due to supply shortage, especially semiconductors, or slower than expected ramp up in demand could be drags to our growth estimates. After witnessing an 85 basis points decline in operating margin for FY 2020 because of negative operating leverage, the operating margin of ICRA's auto ancillary sample X tires is expected to further decline by over 225 basis points to 10.9% plus minus 40 bips in FY21. This is despite the various cost control measures like no production days or rolling out of VRS schemes across companies. Among the auto component players, entities heavily dependent on the M&HCV segment will be the most impacted and could witness margin contraction of over 400 bips, whereas those supplying to tractors and two-wheelers would be relatively better off. Owing to the sharp decline in crude prices earlier in the year, tire manufacturers will witness relatively flattish operating margins despite the relatively muted demand for the full year. Operating margin is expected to revert to normal levels of 13% in FY22, supported by improved operating leverage and benefits of cost control measures that have been undertaken during the current fiscal. The sharp decline in turnover in FY 2021 will release funds blocked in working capital, thereby arresting any meaningful slippages in leverage levels, though coverage indicators are likely to moderate across the board. Large tier one suppliers who have used their cash flows to upcycle to develop a strong balance sheet have been more resilient to the current slowdown. The stress has been relatively higher in the smaller entities and those lower down in the value chain with limited access to capital and stretched working capital cycles. Supported by improved demand and additional financing support from banks, the liquidity position of most auto ancillaries has improved substantially from the June 20 levels, with many entities that availed moratorium benefits skipping restructuring proposals despite eligibility. With improved cash flows and easing liquidity position, ICRA has revised its credit outlook for the sector to stable from negative in December 2020. Capex intensity, which is Capex by operating income, hit multi-year lows during FY 2021 as auto ancillaries focused on conserving cash amidst liquidity pressures. Several ancillaries, including tire majors, reduced Capex by over 30 to 50% in FY 2021. While the Capex is expected to revive in FY 22 from the lows of FY 21, given the surplus capacities available going forward, Capex will be more tuned towards new platform and committed offtakes. Tire manufacturers could incur higher Capex on strong replacement demand. Production-linked incentives announced by the Government of India could incentivize large OEMs and ancillaries to advance their Capex and investment plans, targeted largely at the export markets. This slide talks about ICRA's ratings in the auto component space. ICRA's portfolio in auto ancillary is diversified across rating categories, with bulk of the portfolio sitting in investment grade of BBB and above. Downgrades have trumped upgrades in FY20 and year-to-date FY21 after 6 years, largely because of the industry slowdown. Lastly, on key takeaways, ICRA has revised the industry credit outlook to stable from negative on the back of sharp and better than expected demand pickup across most segments, with liquidity position of most ancillaries improving substantially from the June 2020 levels. However, commodity price headwinds and supply chain disruptions like the semiconductor shortages could derail the recovery temporarily. With this, we conclude the presentation and the forum is open for question and answers. We will first start with the ICRA directed Q&A, and audience can type their questions in the Q&A box on the windows and not on the chat window. Over to you, Pavitra.
Thank you, Vanitha. Anju, can we begin with the poll results? If you could publish that, please. Right. So the question we had asked at the beginning of this discussion was, when do you see Capex reviving to pre-COVID levels? And 50% of you say that it's expected by H2, the second half of FY22. 29% think it will have to wait till FY 2023, and 21% think it's going to happen right or after the beginning of FY 2021. So, thank you. On that note, Mr. Jain, I will start our Q&A with you, and it's a pleasure having you with us today. Let me start with the basics, which is demand. So OEMs account for about 50% of the component demand typically for the Indian auto component industry. So what is your take on demand over the next 4 to 6 quarters, basically 2021? How do you see that panning out?
Thank you very much for having me and giving ACMA an opportunity to talk about industry matters. Now, looking into demand, I think clearly we are seeing a month-on-month strong, sustainable revival of the auto industry. Of course, what 2020 has actually always taught us is there's too much of volatility and unpredictability. So when you actually talk about 4 to 6 quarters and the whole year or year and a half, I think it's quite a long view. However, I think one of the biggest stake, which I think we are underestimating, is this whole vaccine rollout, which started from Jan 16. Today, I think everyone, including all of us, are work from home. There is fear, anxiety. The volatility is largely to be dependent on this whole COVID situation, whether we're going to get a new strain or not. And I think if the vaccine rollout keeps on happening, I think it will boost not just the consumer sentiment, but also the industrial sentiment to actually contain sustainable production runs. And actually, so we are actually pretty optimistic that there will be actually enhanced demand coming in, with a word of caution that if you see that industry over the last 2 years, if you look at it in 1920 and 2021, we have actually eroded almost about close to 25 to 30%. Of course, I mean, so when COVID started, it was actually a much more pessimistic scenario going forward. And with this V-shaped recovery, there's obviously a much more better optimism. So I don't want to guess in terms of what kind of percentage of demand we're looking in, because different sectors will play out specifically in OEMs in a different way. However, we're definitely very optimistic that we will have month-on-month recovery going forward.
Sure. All right. On the second piece of our demand, which comes from the export markets from US, Europe, and UK, which typically accounts for about 60% of our exports, what would your take be on that, sir? And how do you see that panning out?
So we are seeing export orders also becoming quite robust. We are actually seeing good growth in the exports as well. I think there could be certain headwinds specifically on exports, and this is largely to do with actually the container availability. We have seen that when there was a lockdown and imports actually fell, there has been an imbalance in actually the free containers coming in, which were used for basically exports. And I think that's the concern going forward. Of course, in export, there is also the newly appointed issue of RoadTep. And of course, it replaces from 1st Jan the scheme of MEIS. But right now, we don't have rates coming in. So these are temporary adjustments. But I think as a long-term, or about if you look at a year outlook, I think exports also should be performing a lot better and continue to grow.
Do you see any risks emanating from what's happening in Europe on increased lockdown, or what's happening in UK because of Brexit?
Well, actually, if you see in terms of Europe, UK, I think these would be temporary shifts, because the export cycle are long-term cycles. These are long-term contracts. There is material in the order. And just to give you an analogy, when there was a complete lockdown in India, the exporters were the one which actually started off a lot earlier in the supply chains, right? And we were discussing with policymakers to enable exporters to actually let them go, because it's again a process of continuous supply chain. Then when actually there was some temporary lockdown happening again in Europe, the domestic market in India started booming in. And there, I think a lot of basically auto ancillaries use the export capacities to cater to domestic. So I think in and all, it's a good balance. Even in our membership, we have not just 100% pure exporters, we would have component makers who actually cater to both export and domestic. But I think largely as vaccinations also roll out in Europe, in US, in other, let's say, mature markets where India is supplying, I think we should be in a much, much better position.
All right. So on that positive note, let me jump into the headwinds we are foreseeing in the market, one of which is commodity prices. Now, while typically tier ones have passed through on commodity prices, not so much the tier twos and tier threes, what is happening in the market in the current scenario? And given the current commodity price situation, not just for steel, but for almost all commodities, how is this going to impact industry-wide margins over the next 2 to 3 quarters?
I think the industry-wide margin definitely will be under pressure, because what we have seen is a steep commodity price increase. And I think this is probably more not because of the input cost increase only, or inflationary increase, but more of a supply demand issue and global capacity consolidation issue. Look at steel, look at all of the base metals, even plastics, rubbers. I mean, you said there is actually commodity prices have firmed up across basically sectors. So I think there will be going forward increase pressure on margins. However, if you look at again the relationship between the OEM and the supply chain, there are contract obligations where in an up cycle or a down cycle on commodity pricing, you do have certain adjustments coming in quarter-wise or 6-month wise. So it would average out going forward. But definitely, if you look at maybe a very near-term or short-term view, you do see pressure on margin and commodities.
This benefit which tier ones have of a pass-through, does that get passed on to tier twos and threes effectively?
It actually, so you have to see the tier twos in two ways. See, for specifically tier ones, you also do call it like a sandwich situation where you have the big OEMs and then you have the big raw material suppliers, right? And there you have lesser flexibility. And in that case, the contracts do help because you in one way are able to somehow pass the basically price increases which you get from raw material suppliers to the OEMs. Now, when it comes to the component makers, or much more smaller makers and largely the MSMEs, which are tier twos and tier threes, I think there is also an understanding where the tier ones do actually would give, I would say, weighted average price increases or take decreases, across. And again, it all depends. So it's been it's not the first time you've seen these steep increases. And we've actually been able to have a good matured model in the supply chain to manage it.
You alluded to the supply chain, supply demand issues. So that also brings us to the second, headwind which we are foreseeing, which is the supply chain disruption from semiconductors globally. Several global OEMs have shut down production. How's the Indian subcontinent faring, and how bad can things go before they actually get better on this shortage?
So let's understand why the shortage first. This is not an India-specific problem; it's a global trend. And clearly, during the lockdowns, there was a massive increase in consumer electronics and also on healthcare equipment, which uses a lot of equipment and electronics. And in that scenario, when probably the auto sector globally, the supply chains were down, a lot of the tier 2, tier 3 players which cater into the electronics of auto electronics, they actually committed and took that as an opportunity where there were growth sectors in consumer electronics or in basically healthcare electronics to actually commit the auto capacities there. But largely, if you look at a global scale, the auto electronic capacity or the requirement for auto electronics is still minuscule compared to the consumer electronics as well as now the healthcare industry. And India in that share, say India has, at least in the component space, less than 1.5% of the pie in the global value chain. So, the Indian impact, of course, is probably not so much. And of course, what we are seeing because of this massive demand again happening in China, because China is the first, I would say, developed nation to actually recover better. You're seeing actually a lot of suppliers stocking for the auto electronics. We perceive that in about next quarter or so, maybe Feb, March, April, we would have certain, I would say, muted demand, and because of this semiconductor issue. But I think there would be certain solutions. The OEMs are talking with the multinationals very closely. They're also mapping the supply chains, not just on tier 1 levels, but tier 2, tier 3, tier 4s, to see where and how it's going to be impacted. And I think also there is a de-risking strategy coming in. But we continue to wait and watch, and also we'll have to see how the global trend on the semiconductors plays out.
Right. Okay. On to the growth stories now, sir. So we hear a whole lot about the OEMs pursuing a China plus one theme particularly over the last 1 year. And is this actually playing out? And more importantly, is it playing out to India's benefit?
I think instead of just China plus one, at least the COVID situation taught us that we don't have to be over dependent on any one region. Right? Case in point, when actually Wuhan, which was started to show concern even as early as December, I would say supply chains got disrupted globally in January. We started to look at not just deep dive, not just for China, but then also you saw when Europe started getting under lockdown, you saw a lot of supply chain disruptions globally because of the European players where they have a capacity. So I think the clearly trends are showing that you need to de-risk. Before, because of the economies of scale, you used to have one factory catering globally. And I think that's what the trend has shifted. Now, the question is, will India be able to make use of this opportunity, specifically in the auto space? Clearly, we have seen that we haven't probably got that kind of an opportunity instead. And Vietnam or some other ASEAN economies have actually benefited more. However, I think the government intent and the industry intent is very clear to localize a lot more so that we are not so dependent so much on any one economy, and also to see where we can and how we can build economies of scale so that we are able to also have a competitive advantage. Because the reason why we are actually importing right now is, or even anyone in the world imports from one region, is because of the competitive advantage. And I think we'll have to see how we can actually gain this competitive advantage and work to looking more, gaining more share in this whole global value chain.
Would OEMs be okay paying the additional premium to bring at least part of the supply chain closer to home without the economies of scale playing out initially?
I think it's a good question, and I think absolutely that's been a realization. And you also have to understand, just given the rupee, devaluation, the foreign, specifically in India, if you don't do anything, right, in a year period of about 5 years or so, the rupee actually depreciates almost close to about 7 to 8%. So that's where you actually see advantage of even at a short term paying some premium to actually get localized supply chain. And I think there we have to see again the reason why we are not able to localize it. Is it because economies of scale? Is it because of competency? Is it because of any policy or regulation? Or is it just a matter of a low-hanging fruit that we've not really put in our efforts to localize? So I think there's a lot of impetus between industry, between our OEMs and even the supply chains to say, let's make a detailed roadmap on localization.
An often repeated question, I'm sure you'd have heard this multiple times, but once again, sir, how does India gain a higher share of the global export pie? And particularly, can India become a hub for ICE component exports as the developed world moves towards investing more in connected, electronic, autonomous, and shared mobility?
So I think clearly there is an aspiration to become, actually we're saying that in the next 4 to 5 years, we want to at least treble the global value chain share. And I think this is a BHAG, clearly, but definitely the industry has taken it up as a challenge. Also, another challenge with the industry is talking about is how do we become a foreign exchange surplus rather than a net importer as an industry. And I think we'll have to have a two-pronged strategy to it. One would be on to localize, as we just talked about. How do we localize a lot more? Second would be also how do we actually boost our exports? And now for exports, clearly, there has to be a policy intervention. There would be low-hanging fruits. You've said that India doesn't have the capability to become a, let's say, a world factory for ICE components. India already has shown, at least the component industry has shown good quality and capability, where almost about close to 50% of exports are to the US or to the EU. And a lot of them is also on engine parts. So you have the capability here. The key question also is that as globally, the more matured markets are actually moving and investing a lot in the EV, or let's say the future mobility, I think India will have to probably use that opportunity in a different way. And I'll give you a stat, right? You talked about almost globally in LCVs, light commercial passenger cars, 75 to 80 million units are there annually. And of that, I think about 2.5 to 3 million are EVs. So that's just 3%. But I think in terms of investment, a lot of investment is going into EVs. And definitely the ICE components have a good scope for exporting. I think here we need a good policy intervention. I think the industry is looking forward to a PLI scheme, which I think the government is shortly going to announce, where we can actually then probably fast track this export opportunity.
On this PLI scheme, so I'm aware that the fine print's not out, but broadly, what you're aware of, do you think it's a vehicle, it's an adequate policy intervention to push India into the global export markets?
I think we are quite favorable. We have had multiple deliberations with the government, and they had asked for industry recommendation. And both SIAM and ACMA had given us the recommendations. I think what we'll have to see first is once the policy gets rolled out, how we can do it. But one thing I want to say clearly that at least last year we have realized that the whole supply chain is so integrated, interdependent, complicated. So even if a few have got this advantage to take the scale opportunity and grow in the export front, it will definitely benefit the complete ecosystem, right? And I think that's what the government intent is, and but we are very keenly looking forward to the PLI details.
This ecosystem of big and small, do you foresee consolidation happening in the industry over the next 1 to 2 years? And also, do you see inorganic expansion happening by large ancillaries in the Indian markets?
I think the matter of inorganic expansion and consolidation is not a new thing, or it's not something which is just happening within the last 1 to 2 years. It's a global phenomenon. We are an industry which is extremely, extremely competitive. Scale has a very, very large relevance in this. However, I think you will see consolidation happening. However, I think one key point is that it may get because also there is a global trend on technology transformation. And over that technology, there will also be certain investments. In India itself, now we're seeing a lot of startup culture happening within the mobility space. Also within ACMA, we are actually making ourselves more inclusive, not just a traditional auto component manufacturer, but we are seeing also a lot more members who are actually gaining into EV connected space. So I think there's going to be a lot more collaboration within the industry. And of course, in that need more partnerships or even more, I would say, acquisitions.
So more targeted at technology and particularly in the EV space.
Yeah, absolutely. I think that we have to acquire technology. It has to be also fast tracked. We don't have, I would say, the luxury of time, which we used to have in a traditional setup. And we need to leapfrog. So I think there will be investments targeted towards technology. And of course, while you see there would be opportunities to consolidate on the traditional component makers as well.
Would it be worthwhile to consolidate on the traditional ICE technology still?
Well, in my view, I think it would be, and it's very simple. If I was, as an entrepreneur, need to take a call whether I invest or not, usually I would get a return, even in the auto industry, would be in a horizon of 5 to 7 years. And I think within 5 to 7 years, the ICE demand will still continue and will probably grow, specifically in the market India, given also the opportunity that you can be a globally supplier in exports. So I think definitely there would be a good merit case to keep on investing in these technologies and consolidate.
EV penetration, even globally, like you mentioned, in PVs is about 3% and far lower in India. So even though this might be a far-fetched, something along the longer-term horizon, how could you briefly touch upon the strategy of players whose parts could become obsolete because of this transition to EV? Engine component manufacturers.
Well, I think clearly there is a EV radar by all the component players. It's like 10 years before, we always had a China radar. How do you do business with China? What's going on in China? How do we, there was this question asked a decade ago with most of the ACMA members was, how do you see, will China make you redundant? And I think today the question is EV going to make you redundant? So definitely everyone has got their radars up to see what kind of technology, what kind of thrust. But I think we have to have a very balanced approach. We should not really panic saying that, oh, EV is going to come and it's going to completely disrupt all that. You have to understand that India is a very, very unique market. Nowhere in the world, I mean, say, two-wheelers being manufactured and consumed as much as is in India. There is also tractors, farm equipment, which we saw in the COVID times, specifically with the rural economy, it kind of boomed, right? There's CV. There is the CV nature of the CV industry is very different than a European and American one. And also pass cars, a small cars. So I think we have to see what is best for the Indian requirements and needs. How EV will play out in India would probably be very different than how EV plays out in Europe, US, or even China. So I think we'll have to see many permutations, combinations, but I think we are pretty optimistic that we would have an opportunity which will be multi-pronged, multi-segment, and multi-technology.
Okay. Moving on to Capex, first question also spoke about when we saw Capex coming back. So when do you see Capex kicking off again, and what could drive Capex? Could it be capacity enhancement or technology advancements or a combination? Also, given that I think we're still some way off the past peak in auto demand. So would there be a need for investments in capacity enhancement right now?
Well, I think, your poll had a good sense of where the industry optimism level is. Of course, today, financial prudence is a priority. Even with Capex, which is required, or balancing, which is required in Capex, everything is being seen under microscope. Of course, if I look at it, the industry general trend, definitely there is capacities within the industry. The volumes or the peak volumes, what we had before, we are actually nowhere near that in probably every segment. And we have to see also that, you may be having months. Let's say the October month for the PV segment was great. Some of the OEMs were probably having a great run rate. And for that run rate to be manufactured, you need to actually have that much installed capacity. But that doesn't mean that that's going to happen every month on month, right? And they will probably taper down because that had a pent-up demand effect, that had a festive demand effect. So I think we are very, very, I would say, cautious about when and how to invest. So definitely for capacities, I think there will take a little bit longer time, probably in 2023. However, I think a lot of the people have started thinking about when would the next investment cycle come. And definitely, I think on technology front, whoever has the financial bandwidth right now, not so leveraged, been more resilient, I think they are looking at opportunities to invest in technology, upgradations or acquisitions.
On a related note, sir, particularly on EV, what kind of Capex could we need, and do we have the financial muscle to put in that kind of money? Global majors are talking of huge amount of investments going into EV.
Well, if I just heard a number, and maybe later on Vinny can validate that China itself had basically on the electronics, which is the most essence part of EV, including battery, is actually invested close to about 60 billion, right? And that's what the government outlays for that. We probably just are looking at a few billion, if not more. So I think there is definitely going to be a challenge. And first on the localization part of the EV. And if you see EV localization is largely to do with the battery ecosystem and also the electronic ecosystem. And both actually have challenges of localization in India. And I think going forward, as I said, we'll probably have to see what is the right approach for India. There's a lot of deliberation between the industry players as well as the government. The government intent is extremely clear that we want to become, let's say, we want to leapfrog the technology, and that's an opportunity what the whole what India has for the whole world. But I think we'll have to take it slowly in terms of EV. We are also, in discussions with FAME 2 going next. What will happen with the EV? So there's a lot of deliberation happening. But I would like to reserve my comment right now as to what and how EV will play out.
With such a strong intent and, of course, the need for auto electronics maybe to do with EV or even prior to EV in the ICE segment, what is India lacking, which which does not allow us to build a local auto electronics ecosystem?
I think the electronics competitiveness comes on two fundamental pillars: scale and innovation. And scale obviously means whole aggregation, right? And I think today there is a dialogue going on that why not just auto electronics? Why about mobiles? What about consumer electronics? So is it possible to aggregate the complete demand? And then maybe look at what is really required for electronic localization. And in terms of innovation, right, we're not just talking about design, we're not talking about piecemeal. I think as a country, we need to build a complete ecosystem which actually has an understanding of the, not just manufacturing, but more on the development cycle on basically the electronic problem. I mean, say, let's talk about Moore's law. I mean, say clearly, I mean, say the advancement on electronics, the advancements on manufacturing that processes. Clearly, there is right now a deficit on the Indian capability. We feel that with the PLI scheme coming in, which is also promoting, the local manufacturing for electronics and aggregating certain demand, I think that should definitely help India we will gain some traction, on basically producing here and building competencies here.
Okay. So we have a lot of questions lined up, so I'll stop here and take some audience questions. Before that, let me just launch the next poll. Anju? Right. So our next question to the audience is, do you expect to see considerable investments or benefits to the local manufacturing ecosystem under the PLI scheme? Yes, no, and the benefits will be largely restricted to the bigger players. All right. Let me pick up some questions from the audience, Mr. Jain, for you before we get the poll results. So there are multiple questions pertaining to budget expectations from ACMA and government. What kind of support is ACMA expecting from the government for the industry, sir? So if we could begin with that.
I think the FM has really raised the expectations of, I think, every citizen in India, saying that it's going to be once in a 100-year budget or something. So obviously, we are very hopeful that the budget should actually look at demand generation. It should actually look at infrastructure spending, because for us, I think what we need is a sustainable, basically, demand going forward. I think I was listening to the presentation and you were looking at a GDP, which is a double-digit GDP. And of course, if that happens, then we're looking at a double-digit growth for the industry per se. I think we are also looking at certain basically incentives given to manufacturing, industry, because be it in form of PLI, whether it's form of doing an understanding ease of doing business or reducing the cost of doing business, I think that's extremely important. So I think if I were to look at two things, I personally don't think that any GST reduction is either, I think, expected. We as an industry will always keep on asking for a GST reduction, but it's not obviously under the ambit of the budget or FM. But I don't think we are seeing any reduction in terms of taxes, but definitely looking at boosting demand.
Okay, all right. There's a more broader question. So what are your learnings from the COVID pandemic?
I think the biggest learning from COVID pandemic was to put people safety before anything else. Human safety, right? We've always been talking about quality, we're talking about product. And I think, when human safety is at threat, I think we do incredible job. I think as an industry, never before we have come together unified in such a positive way to fight this, I would say, invisible thing. And we continue to do so, be it making work from home protocols or making basically our shop floor safe for all associates to gain confidence. And I think I'm very optimistic going into 2021, as I mentioned before, because of the vaccine rollout. I think this fear and anxiety, what we have, I think that would be actually taken away a lot.
COVID also led to a lot of relooking at cost structures across industries and obviously in the auto component industry also. Do you see the benefits of this carrying over into FY21, or with demand coming back, things go back to normal?
Maybe if I can use the cliche word called hybrid, I think what we have been taught that we found very innovative ways to look at costs. Traditionally, the auto component industry used to have various tools to look at cost, be it VAVE, value addition, value engineering, the annual production links for reduction. But I think here you found extremely innovative ways, work from home, completely actually looking at not just a fixed cost structure, but all cost structure, negotiating contracts, looking at, how we can reduce our break-even points to almost 30-40%. Understand the industry had never faced this kind of challenge that you actually stepped into a financial year with basically one quarter being wiped out completely. And going forward, you still are now talking about a healthy return of the components. So definitely made it more resilient, more stronger, and I think more innovative. And if we are able to come out of this whole COVID scenario, maybe in a few months, and still retain this hybrid model, where we can probably use these certain innovations and probably reduce and keep our fixed costs less, I think those would be the winners, at least in the industry.
An interesting question. What difference did you see in the preparedness between Indian and global companies during this COVID period?
I think when you look at the Indian global, I think, and this is my personal view, India had a lot more resilience and showed a lot more resilience just because I would say variables in India are just too much. Nowhere, I think, when I was talking to my global peers as well, they had a lockdown. They was supported by the government by giving them a direct incentive, by giving them a employee welfare kind of situation. They're also funding the vaccinations. And I think in India, we had issues of not able to fire even the contractual labor. We were talking about, certain de-risking. There was certain, even today you had these farmers agitation. You had an issue which was basically, very domestic issues, be it Carotar coming through. So, multiple challenges, and, there was state and center. We were talking and we've always talked about lives and livelihoods. So I think India was in a much more complex, challenging situation because of COVID. And I think with the way I think the auto components and the auto industry were unified, I think it shows a lot more resilience on the Indian players.
There are a lot of questions again on Evie, some of which Mr. Jain has already answered. So I'll ask Mr. Mehta if he could want to take this question. How do you see Evie playing out in India and demand for auto components because of Evie? Which auto components can see impact and which can gain because of Evie?
Well, I would say that, the happening of the lockdowns in the aftermath of the pandemic have pushed back the EV story in India a wee bit. But again, there is some degree of resurgence that's happening. I would say, the EV volumes in India are not yet enough to excite the component industry to go whole hog into investments. And while most people, largely the tier ones, have some degree of preparedness in terms of, striking joint ventures or technical arrangements, nobody is in fact getting into manufacturing or investing at this juncture. It's still a little bit of a wait and watch, I would say, though it's a space to watch on. It will eventually happen in India, but again, the ICE market will continue to be very, very dominant. Say by 2030, willy-nilly, say if the car volumes go up to 9 or 10 million, the EV volumes I mean, even if you are very, very optimistic and say if they were 20% or 30%, you still would have a huge, huge ICE market still available with us. So I do not think so that the coming of EV is any threat to the Indian existing auto component industry, unless, of course, if there's a point of inflection and we come up with some kind of a technology that really brings down the battery cost to rock bottom. But that doesn't seem anywhere near the horizon. So in such sense, I would say the EV space is a very interesting space to watch. But yes, at what Mr. Jain alluded to, the other opportunities that could play out for India, not very much in the traditional way it's happening in the West, but very differently for India for purpose of exports, could be how it plays out on the connected vehicles, how it plays out in software development. These are interesting areas for the Indian companies to focus on as we move ahead.
Right, sir. Thank you.
Yeah,
Right.
thank you.
Mr. Jain, a question more targeted. Basically, somebody has mentioned that India's largest car manufacturer, Maruti, has expressed doubts about the long-term sustainability of demand. Once pent-up demand fizzles out. So what are your views on the same?
I'm a supplier to Maruti Suzuki and had the privilege of also being on the council of the Maruti Supplier Welfare Association. What I've learned of this amazing entity is that they always basically hope for the best but plan for the worst, right? And I think that's what I think probably Maruti's statement has been, that they've always been extremely conservative. But if you see what Maruti's performance have been, they've been able to gain a lot more market share over the last few years when the industry was even hotting up in competition. So I think what Maruti statement is showing is that we should not get gung-ho on basically an October performance or a November performance or a month performance. You have to still understand that going forward in this whole 10 months, we have actually eroded volume, right? And even the whole year with this month-on-month strong recovery, the whole year we still would be negative double digit. So I think that's where I think point is. And going forward, I think it will take some time to recover back to the same volume levels. But if I may use the word, Maruti, I think, has always, I think, been, I would say, we're talking about a 2 million figure. They were talking about, and if you look at that, then the whole industry goes to a 5 million volume. I think in that long-term intent, I think a Maruti Suzuki probably would have not changed.
A question, sir. How many months of demand visibility are auto component players getting from OEMs? How are suppliers preparing to avoid being unable to meet demand due to capacity constraints like what we saw in recent months with a few players?
So I think it's a very good question. I think traditionally you had basically a quarter visibility with some OEMs giving you 1 month firm plans or even 15 days firm plan. And I think that all changed with not just COVID, but even I would say pre-COVID when the downturn was happening. So I think we are trying to strive for building a lot more transparency. And in this whole digital world, I think a lot of effort has gone in actually putting these capacities, demand forecasting outlooks in a very transparent model using digital tools between the OEMs and the suppliers. So of course, I mean, say our wish always is to have firm, orders for a given period of time, but it's not possible in this VUCA world. And because of that, I think what we are now pushing ourselves is to have much more transparent conversations. And I must say that OEMs have also supported the supply chain a lot more, and the engagement has truly come up. So I think we will see a lot more, I would say, sustainable runs. Also, I must add here that there is a lot of engagement with suppliers, and also now I think the dealer association has also been quite active and trying to build a lot more transparency in the system on the retail front, trying to see what the inventory levels are. So we are able to, going forward, try and build out from the end customer inventory and go all the way to production plans and what the suppliers are having capacities or capacity constraint. I think if we are able to do a back to front kind of alignment and use digital tools to do that, which I think the industry is working on, we would be in a much, much more better position. Hopefully no surprises, at least on the capacity fronts.
So how long do you think something like that will take to pan out?
But I think it's a ongoing continuous improvement process, and I'll give an example. SAP systems. We all have SAP systems, and tier ones and the OEMs are now looking at it. Digital payments. All are having that. I think the whole aspect is that the industry needs to get up for the next level. And be it, say automation, you can call it industry 4.0, you can call it actually the whole this thing. And I think this will be a continuous process going forward. I can only say what we had transparency last year to this year. This year's a lot more. We still track today inventory levels. The customers are pretty much open. I think yourselves as analysts are able to find out what the inventory levels are in this, and that actually gives the first degree of transparency. I think from a capacity point of view, installed capacities are easier to do. So I think it's going to be a continuous process, and we'll keep on improving as an industry for further collaboration.
I know you have a hard stop, sir, so I'll close it with one last question. What would you say to an entrepreneur venturing into ICE space?
I've said that before. I think, let me put it this way. If I have an opportunity, although I don't basically have competency in the IC space, we are more into electronics. But if I were to have an opportunity by my customer and were to invest in basically ICE components, I would invest it, because for me, a return on investment is important. If it comes in 5 to 7 years, I personally feel that even more than a decade, I don't think ICE in India would get disrupted. We probably would have more opportunities opening up in a few years for the, putting up the global value chain and servicing the global order. So I think I'm very, very optimistic, at least on exports, domestic, and even aftermarket to that extent.
All right, sir. Thank you so much. It was a very interesting conversation. Let me just close with the last poll results. The question we had asked was, do you expect to see considerable investments to the local manufacturing ecosystem under the PLI scheme? 45% say yes, only about 10% say no. But Mr. Jain, 45% seem to think that the benefits will be restricted to only the larger players and not get passed on lower.
So I think it's an equal split, but the good part is that 90% are positive either ways, right? So that's a extremely optimistic note to end on. And I think if we need growth in the economy, right, it will never come if we don't invest. And I think that's one of the key questions. I think that's where, if the industry keeps investing, be it policy driven or be it demand driven or OEM driven, I think we would be pretty much back on track in terms of the growth. So I think we are very optimistic, and definitely they're going to be exciting times ahead.
All right, sir. So thank you so much, both of you, for a very interesting conversation. And
thank you for giving ACMA the opportunity on this platform. I appreciate it. Thank you so much.
Thanks a lot, sir. Thank you. Bye-bye.
Thank you.